what we are going to do today is we are going to estimate three GARCH models that are Beck, GARCH Beck, or M GARCH Beck. It is called as M GARCH Beck, then M GARCH DCC, then M GARCH CCC. Okay. Then before M GARCH, we need to do the VAR, that vector autoregression we need to do. This vector autoregression will run the mean model regression for mean model, and for M GARCH models for variance model. Since it's a bivariate or multivariate model, we need to go for a VAR Beck or VAR DCC or VAR CCC or any of the bivariate or multivariate mean model. So can anyone give example of other bivariate or multivariate mean models? In last class we have discussed. Can anyone give example? Other than VAR is one of the mean model, right? Bivariate or multivariate mean model. Any other models? Can anyone give example of bivariate models? Anyone? That day we have discussed, right?
So, or Granger causality,
Yes.
Varma.
Yes. So causality is one of the only bivariate model. So then Varma, then the co-integration models also. Engel-Granger co-integration model is a purely bivariate co-integration model. So whatever we have discussed, like this bivariate and multivariate model in last class, you can use either VAR or Varma. Those are, or Varmax. There are n number of developed bivariate and multivariate mean models. So, but the base is VAR. Above VAR, whether you go for Varma, Varmax, or any of the model, then we come out with M GARCH model. Now the idea is to build mean and variance model at a time, and that way with a more than two variables or multiple variables. Okay, that's why these are all multivariate GARCH models. Okay, these are all multivariate GARCH models. Okay, so now for VAR, what we need to decide the log length, isn't it? How do we decide the log length? What are the criteria for deciding the log length? Can anyone say how we can decide the log length criteria? What is log length? Can anyone say? Can anyone say what is log length? Shruti, what is log?
Yes, sir. So we did ACF and PACF for lag selection.
Yes. So how you can get the log through ACF and PACF? How we can get? How does SCF and PSF helps us to get the lag length? Anyone? What is SCF and what is PSF? Quickly. You have studied in econometrics also. Pragya, what is SCF and PSF? Srinidhi? Anyone? What do you mean by SCF? Shruti, what is this SCF and PSF?
Sir, so you explained that for for partial autocorrelation function, we only see for yt minus 1 and yt, but for total ACF, we will see the overall, we will consider all the lag periods, like from yt to yt minus 1, yt to yt minus 2, that way. And then we did that PACF chooses lag for AR and ACF for ME, and that's how we get the lags.
Yeah, so this is autocorrelation function and partial autocorrelation function. Autocorrelation function will check the autocorrelation between yt and yt minus 1, yt minus 2, yt minus 3. If it is yt and yt minus 5, that means it checks yt minus 1, yt minus 2, yt minus 3, yt minus 4, and yt minus 5. But in partial autocorrelation function, it will only check between yt and yt minus 5. So what we can get it? We can get the autocorrelation function. Also, we can get the partial autocorrelation function. If that decay is happening, we will come out with something called correlogram. Anyone has heard about this correlogram? Anyone has heard about correlogram? Yes or no? Yes or no? अरे
Yes,
कुछ
sir.
तो बोलो.
Yes,
Yeah.
sir.
So what is that correlogram?
Sir, we don't know, sir. Can you
What is
please
that
explain?
correlogram? Okay, who is this?
Sir, Naman, sir.
Hi. Yeah, I'll
Hi, sir.
explain.
Yes, sir.
I'll explain what is correlogram. Can anyone say what is correlogram? Kamal, whatever you know.
So I don't know anything about it. Please explain.
Okay. See, whenever we do this autocorrelation function or partial autocorrelation function with different autocorrelation functions, if we add all the autocorrelation functions, we will come out with a autocorrelation plot. That plot is known as correlogram. What is that correlogram? What that correlogram represents? If you see this correlogram, this is the autocorrelation SCF correlogram, and this is the partial autocorrelation correlogram. And the correlogram is nothing but the correlation that correlation value varies from -1 to +1. So same for SCF and PSF. So it will vary from -1 to +1. And how does it helps us to decide the log order? Okay. If you can say this SCF function is slowly decaying, the autocorrelation function at log 1 was very high, and whenever we pass on, it is slowly decaying, it is not decaying fully. But if you observe in the PSF, partial autocorrelation function, this particular autocorrelation is there in the first day. After that, it is reduced or it is decayed. We call it as decayed. Now we can say for PSF the log is 1, but for SCF, can you say what is the log? So it, by considering SCF in this correlogram, it is difficult. Okay. Now we can do different correlograms and find out which is our log. So this is one way we can see the autocorrelation function or partial autocorrelation function. The log will be whenever autocorrelation is at peak level and it has started decaying. Now from that point onwards, we will not consider that as a log and we will stop at that point. We'll take some more example of other other correlogram, how it is. So just see, this is one SCF and PSCF. You can see whether it is this model will be what. This is SCF is the highlighted one, and the yellow one is the PSCF. Okay. So if we say actually PSCF is there for measuring the log for AR, and SCF is there for measuring the log for MA. Now if you consider SCF, this shaded SCF plot is totally decaying after 1, isn't it? Are you getting?
Yes, sir.
If you see this SCF function, the SCF plot, we want to decide the MA log. Then if you go on, after 1 log, in the 2 log, there is nothing. It's almost 0. Then after that, it's almost 0. So the MA log is 1 over here. So we can say this is MA1. Come to second part. Here SCF again the you can see after 2 log SCF is decreased. Okay, so here it will become how many MA log? How many MA log? 2. After that it is reduced. So by considering SCF, now come to here. Now we want to decide the AR log. Okay. For AR log, we consider the PSCF. Now for PSCF, whether it is, this is PSCF, the yellow bar, what will be the AR log over here? This is
Sir,
called one correlogram.
Sir, for AR and MA, did you like for both of them like did you observe PSCF only?
No, not for both of them PSCF. This is we will consider
sir, in
over
the
here
MA we were
for MA SCF. Okay, for MA we are considering SCF. You can see here the highlighted one is SCF.
right. Okay.
Yeah. So
Okay.
if you come down, this one is PSCF. So this PSCF is in yellow. So PSCF is for AR, SCF is for MA. Now, what will be the log for AR over here?
One.
AR1 or MA1?
Sir, AR1. Sir.
AR1. If you come over here, if I want to decide AR lag, from this correlogram,
Again 1.
again 1. Okay. Okay. If I want to decide again AR, this is also 1. Okay. Either side. Now you say from here, what will be your lag? Can it be determined? So you can say AR will be 1. Okay. But because PACF after that has got reduced. But what about SCF? If you say, if you will be asked to uh, get the MA lag, what will be the lag? Is it decaying? SCF is decaying?
No, sir.
It is not decaying. It is called non-stationary series. Okay. So this is one way. Then you can differentiate your data set and make it stationary. Then you can come out with identifying the lag. So this lag, we can either select through SCF or PSCF, or we can go for information criteria. So those information criteria you all are aware. Those are very popular, are Akaike information criteria. We'll use that Akaike information criteria to get the lag of for the var. Okay, you can use any of the criteria, but AIC is more preferable. Then we go for Beck model or DCC model. So how many of you are having rats so far? Can you raise your hand, or you can tell? How many of you are having rats now? This rat software. How many of you are having? Yes, please quickly. How many times I will repeat? Shruti, you are having?
No, sir.
Komal? Anushka, you are having, right? Agrima?
What?
Agrima, are you having these rats?
Yes, sir.
Faraz? फराज अरे कुछ तो बोलो हाँ या ना
सर डिस्टर्बेंस आ रही है सर मेरे को सुनाई नहीं दिया कुछ पीछे का
you
अभी तो
are
मैंने
having
लॉगिन किया 2 मिनट पहले सर
are you having rats
सर डाउनलोड किया है मैंने और मेरे लैपटॉप में कुछ इशू आ रहा है मैं वो एड्रेस करने की कोशिश कर रहा हूँ और मैं फ़ोन से लॉग्ड इन हूँ तभी मैं लॉगिन ही नहीं कर पा रहा था लैपटॉप से और मैंने फ़ोन पे लॉगिन करके बैठा हुआ हूँ
ये जो रैट्स है आपके पास वो एक्टिवेशन किए क्या उसको वो जो लैपटॉप
नहीं
में
सर
जो
वो वेरिफिकेशन कोड नहीं भेजा था मैंने इंस्टॉलर तो सेटअप कर लिया था वो इंस्टॉलर तो डाउनलोड किया था मैंने
तो
इंस्टॉल हो गया था
वेरिफिकेशन
उसके बाद
कोड
फिर
के लिए भेजो ना नहीं भेजोगे कैसे होगा भेजोगे तो वो देंगे ना
हाँ सर मैं भेजता हूँ सर
ओके हर्षिता यू आर हैविंग रैट्स
Sir, it's not opening.
कैन यू शेयर योर स्क्रीन
Sure, sir.
where is rats you have installed हर्षिता
Sir, I had installed it and I got the activation code as well, but I don't know what is happening right now.
Then it
I'll
it
have
will
to
be
look
there
into it.
in your search box. Just write down rights. If you have installed, it will be there only.
No, I even gave the activation code right now as well, and it opened, but it's not opening. I don't know why.
Just
Let me
share
just share
what
it.
you have
One second.
unshared. Just share your
I have
screen.
to share it. See, it has opened.
Yeah, it will open. Okay.
Yeah. वो
Yes.
file will reach
Okay.
man.
So do one thing, Harshita. The file that I have sent to you today, just download that file. You have downloaded that file, the RADS file.
I had today one. I think about
No, this was 2 days ago. Don't download this. Come back. Download 2 days on. You can close this. Today I have sent to you, na. This one, first one only. No, not this. Go back.
what are you talking?
Go back. Yeah, just open your Mac. Open your mail, Harshita. You are there. Yeah.
Yes, sir, I'm doing it.
Yeah.
Is it
Just
this
see.
one?
No, this one. Yeah. Just download that file. Yes. I think it's getting downloaded.
Sir, what to do?
No, it's getting
No,
downloaded.
no,
You can see. Go to your
no. That
download.
was
It's getting downloaded. That is showing in your browser. Go to your download.
sir,
Chrome download.
it's not.
I think your
So this
system
was.
is having some problem, but that the idea is you just open that file, go to your download. It is
Sir, I'm opening it, but it's not.
no, your system got hanged somehow. I hope. Okay. Okay, you try that. Now, those who are having rats, please open that. We'll first estimate the bake DCC, CCC, and then we'll calculate the optimal portfolio weight. Okay. So this optimal portfolio weights based on any of the MGARS models variance covariance matrix that is generated through any of the MGARS models. So either you can use BAKE or DCC or CCC. So if you see, if you come to of those who are having RADs, use it. Those who are not having, download it, install it now so that you can submit the assignment accordingly. Now if you see, I am opening my data. So you can either go to data and graphics, go to data from other formats, and you can click on this data, GIP. Then you say, okay, yes. So it will, data will be imported. Okay. Now once data is imported, what you need to do, you need to select the bar. You can say this lag is maximum lag is 20 or 10. Then you can, then you can use, you can run this. Okay. Then don't do control enter, simply do enter. So it will run. Now you can use all the variables over here, all the 5 variables that we have in our data file. You can use all the 5 variables over here. You can also paste wherever variables are written, and you can use those 5 variables wherever guards is written. So this is guards. Now you can come out with this after slash, just paste the name of the variables after slash. It is there in the second guards and third guards, like that is CCC and DCC. Now what you need to do is, you need to run through this particular guards. For that we want to select the lag. Okay, you can come through lag selection for this. For these variables. So what based on AIC,
The 5.
you can see this star is coming at lag 1. That means ours is lag 1. Yeah, someone is asking something. So lag is lag for this bar is 1. So we can write down lag as 1 over here because we have selected 1, and bar 1, the model is bar 1. Then you can run through. Then over here you can say P equals to 1, Q equals to 1, and bar equals to 1. What is this PQ? PQ are the maximum lag for arch and maximum lag for guards. So for PQ, you have seen in case of ARMA or ARIMA something called PDQ. You have seen this PDQ. What is this P? P for maximum lag for arch, and Q is maximum lag for guards. Okay. So how do we decide how much lag will be there for arch or guards? We have decided bar lag, right? Bar 1 lag, isn't it? Yes or no? This is bar 1 based on this bar result. Okay. This based on this information criteria. Okay. Now what we want to give the lag for arch and lag for guards. Since guards is carrying two components or two coefficients, one is arch, another is guards, whether it is univariate, multivariate, or bivariate. Now what to do? What we need to do is, when P equals to 1, Q equals to 1, we are saying this guards back is 1, 1. So why by default we are giving 1, 1? Because this 1, 1 model is this is proved that back 1, 1 is the best fit model. But we can change this 1, 1 to 2, 2, 3, 3 or 2, 3. So based on some trial and error method, we can check. Then again we have to see the information criteria. Whichever model are having less information criteria, like either AIC or SBC or all of them, we'll compare with different lag of GARTS models, then whichever is having less information criteria, we'll select that. So by default, GARTS 1.1.
Hello, sir.
Yeah.
So my var lag is coming out to be 9 point something. It's not 21 point something.
Which data you have used?
The data GIP thing you sent last time.
Sorry, which data?
That data GIP one, which was sent on 3rd April,
The same,
6:20.
this RIGOP, RMICX, same data.
I haven't changed anything. I just imported the data and then I just clicked enter.
Can you share your screen?
Yes, sir. So actually, I'm connected to phone right now. Just a second.
You can show your phone to your system, we can see.
No, sir. I'll just connect to the meeting right now.
Okay, you just show me. It will not happen like the same data will give 1 lakh in one system and 9 lakh in other system. It will not give. So can anyone say if it is 5 lakh, what does it mean? If we are getting its lag is 1. You can exit from 1, Sanjana. So if lag is 5, then what does it mean? Can anyone say? If we are getting var lag as 5, what does it mean? Shruti? So this means combinedly 5 days or last 5 days are impacting today. Okay. If we'll say today's impact we want to measure, like how many last or how many lag is impacting today. So it is like today's, if it is yt equals to, or yt depends on yt minus 1 plus yt minus 2 plus yt minus 3 plus yt minus 4 plus yt minus 5. Okay, that means 5 days are combinedly impacting today. If I consider this as today, then I will add one more over here. So this becomes yt minus 4, this becomes yt minus 3, like that. So combinedly last 5 days are impacting today. That means each data depends on its own past values for 5 days, or last 5 days of its own past values are impacting today. Okay, so suppose I'll say Naman, whether Naman is dependent on its past behavior or not. So I need to check, suppose Naman is now becoming the head of risk management of say Edelweiss. Now he's managing, he's the head of Edelweiss risk management division. Now whether he will be happy or not. Naman, you will be happy or you will not be happy?
So it depends on my salary, sir.
Yeah, of course. You are heading means your salary will be at least in 2-digit lakhs. So corporates provides minimum 50 lakhs plus. Suppose you are getting 60 lakhs salary. So
Course,
they will,
yeah, I'll be happy.
first criteria is they will not give you now. So you will get after say, you will get after say 5 days or sorry, 5 years or 10 years. Suppose you had 10-15 years experience, then only people will give you to head one division. Now you have 15 years of experience and now you are placed with 60 lakhs package, you will be happy?
Yes, sir.
So how many days you will be happy?
Till my next objective is in my mind, I'll be happy by then, and then maybe I'll be, you know, uh, introspecting, and then I'll be thinking that others are who are in my field are earning more than me or something like that.
Yes, so you will be happy for some period. Maybe it is for 1 year, 2 years, or 5 years, or or say 6 months, or maybe 5 days, 10 days. But when you realize that other friends from your class, suppose say Komal is getting 70 lakhs, Akshat is getting 80 lakhs, then you will say, I am little behind to them. I need to cross them, right? So your happiness is there for 5 days or 10 days, then your lag becomes 5, or you are dependent on your last 5 days behavior. So you got appointed before 5 days. Now you are very happy because you are heading the division as well as you are earning good salary. But when you realize that your other friends are getting higher salary, then you will feel little sad because you also want to get higher than them. Okay, so that is what whether 5 days or 5 lakh or 10 lakh is indicating to us. So it is combinedly last 5 days is impacting today. Okay. Yeah, Sanjana, you are
Hello,
asking
sir.
something. Hi.
So can I share my screen now?
Yeah, please share. Please share quickly.
So you're presenting still.
You can share. You can share.
Okay.
My presentation will be first.
Mm-hmm. So can you see my screen?
Yeah, it's coming.
So I took this data.
Go back.
Um,
Go back to your rights.
uh,
Oh yeah, just see one thing. You are using the previous file, I think. See, you have selected two variables only. Under var, you are saying you are getting R IBOV and R MICX. Just copy this R IBOV to R top 40. Yes, and paste it over there. Yeah.
and then I should and
Yeah, just remove those two or select those two
what?
and paste it.
So क्या
Yes.
remove करना है?
Sorry.
So what to remove? I didn't get you.
Just you have copied that, right? Now you need
Yeah,
to
I've
paste.
copied.
I need to paste it here wherever R IBOV is written.
Okay.
Select that R IBOV
Your,
to
oh yeah, here.
your voice is breaking. Just
Hello.
yeah, now you are audible.
Sir, और कहीं change करने क्या? So I've changed it in the lag select part and the variables part.
Then again below you can see system model equals to var1 variables. After variables again you need to paste the all the
Yeah, I
variables.
changed it. All the 5 variables, yes.
It's not visible to us, I think. Yeah. Then again come this guards line, come down. In this guards line, go to end. Just scroll it. Yeah, just scroll. Yeah, here you need to give all the 5. Yes. So you come down again. Come down in the other guards. If you come down in other guards also, you need to change it. Yes, it is there, but now for you the capital letters are coming, na? Just paste it. Yeah. So again, come down to the third one. Come down. Yes. Scroll it. Yes. Now you run, you will get lag 1 only. Okay.
So should I start running from here? The bar lag select.
Yes. You can remove all these this right hand side. In the right hand side, just say Control A. Click your cursor in the right hand side where you are getting the result. Yes. Now it's good. So you can no. You just cancel it.
Okay.
So you can now run through from the var select. Already data is there. You just
Yes,
run
sir.
through from var select. Yes. No, you just keep your cursor at var select. Yes.
Like this.
Yes. Just enter. Then again enter. Yes.
Okay.
Now you are getting one. Yeah. Now like
Thank
that
you,
you
sir.
can do it. Okay. So lag 1 we are using is var 1. If you are getting for any of the data lag 3, lag 4, lag 5, any lag, you can change over here in place of system. You have to give which var 1 or var 5 model. Then over here also you need to change. Okay. So now we want to run this. Sorry. Now we want to run this var1 bake11 model. This is multivariate GARCH 11 or mGARCH 11 model. Okay, mGARCH 11 model. What does this mGARCH 11 model do? What does this mGARCH 11 model will give us? It will give us from one variable. It is running. You can see that stop is there in red color. If it will be in normal color, then you can get the result in the right hand side. So it is running. It will take little time. You can give time to rats to run this bake model. Now I will tell you how to use that bake model. So we have two things. One is whenever you run any of the arch model, one is arch coefficient, another is GARCH coefficient. For arch coefficient, whatever suppose we are getting the significant coefficient, we say this arch coefficient measures the short term volatility spillover in case of mGARCH models. These are all mGARCH or multivariate GARCH model. So this is short-term volatility spillover, and in GARCH, whenever we get the GARCH coefficient, it measures the long-term volatility spillover models. Okay. Now you just see we got the result. All of you got this result. All of you got this result. So I can copy this result. I can show you what this result is and how to interpret these results. Okay. First is mean model, or we call it as mean spillover model. You can see from R by IBOV, or these are all 5 countries indices. R IBOV is the indices of for which country? For Brazil. So IBOV is the index of Brazil. Then MICX is the index for Russia. Then Nifty is the index of which country? Nifty is the index of which country?
India.
Are you sure?
Nifty, yes.
Okay. So then we have R Shanghai composite. This R means return. Okay. The Shanghai composite means it's an index for China. It is Shanghai Stock Exchange of China. Then we have South Africa index, that is called R top 40. What does this top 40 means? It is the uh, we have something called Johannesburg Stock Exchange in South Africa. So Johannesburg Stock Exchange top 40 40 stocks index is called as top 40 index. So these are all representing of one of the BRICS countries. Now you can see, now for this mean model, what we are saying, whether return of one country is spillover to another country, or any of other countries are impacting to one country's return. In the other hand, we are seeing the variance model. These are all variance model below this, whether one country's volatility is spillovering to other country. Okay, so you can see this IBOF or Brazil depends on its own as well as own lag. It is lag 1 because we got VAR lag 1. So it is one lag, then MICX lag, that is Russia's one day, India's 1 day, China's 1 day, and South Africa's 1 day. So these are coefficient, standard error, T start, and significance. You can convert it into column so that it will be yes. Now you are getting all things in column. Is it visible now? So this is coefficient, this is STD standard error, and T start and significance. So these are the coefficients that we get for each of the models. Whenever you run, either it is regression or auto regression or VAR or back, anything. So what is this coefficient is the magnitude of impact. Then standard error will tell how much standard deviation or how much deviation is there, or probable deviation will happen in the coefficient. Then T start or P value will give us significant or insignificant of the coefficient. So either you can use T or you can use P. So any one you can use. You may delete this T, since T you have to see the tabulated value and the estimated value, then you compare. So you can delete this T, you can use this significance level. Now in this significance level, whether this is significant, first one, is it significant or insignificant? This is the P value or probability value. Significance means this is P value. Whether this is significant or not. All of you are able to see? All of you are able to see?
Yes, sir.
So this is significant or insignificant?
The significant.
This is significant?
Yes, sir.
At what percentage it is significant?
Even till 30, it is. So this is
30.
30.
Sir, it's not significant.
Is it? It's not significant, it's significant. So the P value is 0.3861. 0.3861. So someone is saying it is significant,
P value should be lesser, maybe.
and someone is saying insignificant. So which one is correct? Whether it is significant or insignificant? Yes. Up to what significance level we can accept?
5%, sir.
5%. So in a rare case we go for 10%, but or else we can go up to 0.05%. So this 0.38 is less than 5% or more than 5%?
So more than
38% is more than. So it is
yes,
significant
sir.
or insignificant?
Insignificant, sir.
It is insignificant, not significant. So if it is insignificant, then we say there is no impact of this coefficient. That is, the RIO or the Brazil stock market index, 1 lakh of Brazil stock market index is not impacting itself. So that is what we infer from here. Because if it is insignificant, we say this impact is 0. Now this one is significant or insignificant? MICEX.
Sir, only constant is significant. Nothing is insignificant.
No.
Sorry. Yeah, the constant is significant. Nothing is
Again, if we go for 10% significance level, this one is significant.
yeah, if we go for 10%, yeah, correct.
Yeah. So up to 10% we can go. So constant is significant. Then this South Africa is significant. So 1 lakh of South Africa's return is spillovering to today's return of IBOVESPA. Okay, we can say that. Then same for MICX. MICX is for Russia index. So which is in significant? Which is significant? This is 0. It is significant or insignificant? Quickly.
Significant, sir.
This is significant. This is significant, right? So if we go for these two, these are insignificant because they are more than 10% or more than 5%. Now if you come to this Shanghai Composite, RSHCOMP, this is significant or insignificant? Yes?
Significant.
Significant. Now the next one, 42%, significant or insignificant?
Insignificant.
So only then constant is significant. Okay. So you can say this MICX or Russia depends on 1 lakh of China market and 1 lakh of Brazil market. So Russia's return depends on Brazil and China's 1 day lag return. Okay. Or 1 day lag return of Brazil market and China market is spillover into Russia market. So like that you can do interpretation of all the main model. Can you do? This is our Nifty. Let us see this, how Indian stock market return depends on other countries. Suppose say IBOV, this is Brazil, whether it is significant or not. Yes or no? This is 0. This is 0, whether significant or not. Yes?
Significant.
Harshita? Yeah, Pragya?
Significant.
This is significant. Then this one, 0.05, that is Russia stock market. Significant or not?
5% पे देख रहे हैं
5% पे, हाँ 5% और 10% तक देख सकते हैं. We can go up to 10%. Okay.
सर 5% है तो फिर तो insignificant है.
हाँ, we can go up to 10%.
Okay.
So 10% है तो ये significant है. Then this one, significant. So these two are insignificant. Like Nifty on its 1 day lag is insignificant. Shanghai Composite like China is insignificant, but what happens? South Africa, Russia, and Brazil are impacting to Indian market or Indian market return in 1-day lag, or the return of Brazil, Russia and South Africa are spillovering to Nifty with 1-day lag. Okay, suppose yesterday's return of Brazil is reflecting or impacting today's Nifty return. Okay. Then you can see whether it is positive or negative. Let's say Russia is negative, then Brazil is positive, you can see. Now you can do interpretation for each of the mean model. Yes or no?
So this is the spillover for returns, right?
Spillover for returns. Yes. You can do up to this, it is spillover for returns. Now we are coming to the variance model. Okay. This is the variance model. So what is this? What are these? This is taken to 1 second. This is taken to only yes. Now you can say this is okay. One significant thing we are missing. Okay, we can write down these 3 things over here so that it will be clear. Now just see C11. Okay, C means it's constant. If you come down, A, B, C, 3 things you are getting from this variance model. Okay, so C means constant. Okay, so you can say C11. This will come over here only. So we say C1, 1. Okay, this is called C11. Like that, it is written in the result also. You can see this is C11. Okay, when we have converted into columns, somehow this comma has been separated. Okay. Now what is this C11? It is the constant of first variable. 1, 2, 3, 4, 5 means first, second, third, fourth and fifth variable. Okay. What is first variable? You can come over here. The first variable is Ibovespa, or you can see your order, the order of your variable. You can see. So first variable is Ibovespa, isn't it? So it will come as 1. Second is MICX or Russia, that is 2. Third is Nifty. Fourth is China. Fifth is South Africa. Now from the variance model, can you identify which one are, anyway, constant we don't interpret. You come to this A and B, which one is significant? You can okay. So you can see now from this significance or significance p value, which are significant from this A. So this is A11. That means its own spillover. We say A11 means the Brazil markets to Brazil market, or one variable to that same variable only, whether volatility is spillovering or not. So it is significant or not. This is p value, right? This A means arch coefficient, B means Garch coefficient. Okay. Then you can see different combination of A. First one is 1, 1. 1, 1 means first variable to first variable. And 1, 2 from second variable to first variable. 1, 3 third variable to first variable. Then fourth variable and first variable. Fifth variable and first variable. Then you see first variable and second variable, second to second, third to second, like that. So can anyone say whether this is significant or not? The last column is p value. P value is 0.00. Whether it is significant or not.
Significant.
So what it indicates? It indicates its own spillover or own volatility is impacting to its own volatility. That means it depends on its own volatility, or own volatility spillover is there. So it is natural that own volatility spillover will be there. So I will be depend on my past behavior, and that will impact to myself. That is natural. But what we are more interested is cross market volatility spillover. What is that cross market volatility spillover? What is cross market volatility spillover? Can anyone say? Cross market volatility spillover means from one market to other market. That means between Brazil and India, Brazil and Russia, Brazil and South Africa, Brazil and China. Okay. So whether that spillover is there or not there, that we will check. So this one is there or not there. From second variable to first variable. That means Russia to Brazil. Whether it is there?
No.
No. So this one, third to one. Third is the India. India to Brazil. It is there?
Yes.
So it is there. Now this one is not there, like China to Brazil. This South Africa to Brazil also is not there. Now you can say 1 to 2. That means first variable to second variable. First was Brazil, second was Russia. So Brazil to Russia, it is there or not? Yes or no?
No, sir.
So this is from one spillover 2 to 2. That means Russia to Russia. It is there? Yes? Yes or no?
Yes.
Yes, sir.
But other than this, you can find out all others are insignificant. If you come down, the significance is 3 to 3. That means Nifty to Nifty or India to India. So Nifty depends on its own volatility spillover. Again, 4 to 3rd. 4 is the China. So China to India volatility spillover is there. Other than that, India is not depending in other markets in terms of volatility. Okay, because this is also insignificant. Like that, you can interpret. So these volatility, since it's arch coefficients, these are all short-term volatility spillover. You can say short-term volatility spillover from China market to India market is there. Then you can say how much percentage of volatility spillover that happens. It is 0.05%, and its own spillover, like around 40% of own volatility spillover is present. Okay, if you come down, so can anyone interpret this, whether spillover is there from third variable to fifth variable? Yes or no? Yes or no?
No.
No.
No. So if I say 5 to 5, spillover is there. Okay. Now this is end of short-term volatility spillover. When beta B coefficient starts from B, this is nothing but the Garch spillover or the long-term volatility spillover. So 1 to 1 it is there, long-term volatility spillover. Then 2 to 1 it is there. Okay. Now this is not there. These two are insignificant. These three are significant. So you can identify which are significant, which are insignificant. So based on that, you can interpret and you can see the magnitude of volatility spillover. Okay, this is there. This is present. This is also present. This is present. Now you can use this Beck spillover or Garch-Beck model to identify own spillover as well as cross market spillover in terms of return as well as volatility. So in terms of return, you can see the mean models. In terms of volatility, you can see the variance model. Under variance model, what you need to see? You need to see the arch coefficient and GARCH coefficient separately. Arch is for short-term volatility spillover. GARCH is for long-term volatility spillover. Any doubt, you can ask me. Any doubt?
No, sir.
Okay. Now come to next level. We can see some of the diagnostic test. So you can say five, since 5 variables are there, so 5 times we need to see the diagnostic test. So we have autocorrelation, heteroscedasticity, all those. So basically a heteroscedasticity problem will not be here because it's a heteroscedastic model. Autocorrelation problem may arise. So you can set this Z1, Z2, Z3, Z4, Z5 and do the bind test. Okay, you can run at a time this. You will get for each of these you will get long term LB statistics, that is for autocorrelation. So macloid is for heteroscedasticity. You can check both the statistics. If it is significant, that means autocorrelation is there. If it is insignificant, autocorrelation is not there. So here autocorrelation is present. Now here it is not present, here it is not present. It is not present if we consider 5%. It is also not present. Now the idea is to why we are doing this particular MGARCH model. We want two things. One is its variance, or we call it as its own variance, and like 1 1 2 2 3 3. Another is covariance, 1 2 1 3 1 4, like that. So why we want this variance covariance matrix or conditional variance covariance matrix? Because we want to use it for optimal portfolio calculation. For this optimal portfolio calculation, what we need to give is HTI, STJ and STIJ. That is, STJ means conditional variance, HTIJ means conditional covariance. So IJ means ith security and jth security. J means only jth security. So we can identify optimal portfolio for ith security. So between I and J, or between two security, we can allocate the optimal portfolio. So for that, we need this variance covariance matrix to apply this particular formula. So how can we get it? We can get it by running this set V1, that is the variance of 1, variance of 2. These are all conditional variance. Then variance 1, 2, that means conditional covariance. So you can run through this. Rho is not required for this particular formula. You can run this variance and covariance. You can run one by one, or you can run is like this. And you can simply say over here print. Okay. If you say print, it will print the variance covariance result. If you come up, if you go off, you will find this is okay. This is row. We have not run row. Okay. If you go off, all of you are getting. Just see B34. B34 means covariance between third and fourth, third variable and fourth variable. Third variable covariance between third variable and fifth variable. If you come up, you will find its own variance, like okay, this is Z1. that V1, we have said something called V1, V2. You can copy this result to an Excel sheet. Okay, you can copy these results to an Excel sheet and you can identify all those V1, V2 and V3 and V12, V13.
सर ये आपने जो दिखाई हैं फिगर्स वो कोवेरिएंस की हैं।
हाँ, कोवेरिएंस की। और
सर
भी खाली
नहीं, बट हर एक ऑब्जर्वेशन के अलग कोवेरिएंस क्यों निकल रहा है?
हाँ, एक वेरिएबल का, सी इफ इट इज, okay, this is Z1. Suppose it is V1, you can see here V13, a first variable and third variable का covariance. Okay, V12 second variable and first variable का covariance. V14 fourth variable and first variable का covariance.
हाँ, चीज आई, बट आपने नीचे एक रिजल्ट दिखाया था जिसमें हर एक मतलब जहाँ पे आप मेंशन कर रहे थे वी, ये देखो V1 है, V13 है, वैसे करके कुछ मेंशन कर रहे थे आप।
हाँ, ये जो आएगा ना, ये जो V13 जो जिधर आएगा ना, ये फर्स्ट वेरिएबल और थर्ड वेरिएबल का कोवेरिएंस ही है। समझ गए ना? देखो, अरे ये जेडी आ रहा है। जैसे ये है V34, ये V34 कहाँ पे हम सेट किए, ये है V34। ओके, सो ये थर्ड वेरिएबल एंड फोर्थ वेरिएबल का कोवेरिएंस। समझ गए ना?
बट सर फिर नीचे एंट्रीज क्या है?
नीचे एंट्री मतलब
ये एंट्री नंबर 1 2 3 जो मतलब
okay,
ये क्या
so
है?
we have 4000 observations, 4194 observations. So we'll get one series of covariance, every day's covariance. Okay, now now we need to use this to calculate that portfolio weight. So each day's portfolio weight we'll get. Suppose we have 4194 observation, we are getting 4194 say variance and covariance. Now when we calculate the optimal portfolio weight, each day's weight we will get.
बट सर कोवेरिएंस तो एक नंबर होता है ना, एक सीरीज का मतलब दो सीरीज का एक नंबर निकल कर आता है कोवेरिएंस, ऐसे अलग अलग क्यों आ रहा है?
हाँ, एक नंबर जब आएगा ना, वो हमको उसका क्या बोलते हैं, मीन देता है, उसका एक कोएफिशिएंट आता है। लेकिन जो कैलकुलेशन ऑन द बैकग्राउंड होता है ना, ईच डे का कोवेरिएंस देता है। ठीक है, आप जो बोल रहे हैं कोवेरिएंस एक्सेल में डाल के आप यू गेट वन कोवेरिएंस, वन वैल्यू ओनली, राइट? सो व्हाई वी आर गेटिंग हियर ईच डेज कोवेरिएंस? That is your doubt, right?
Yes sir.
So what we are getting there is the average of all these covariances. Now each day's covariance we are getting. Now we can get the average of this covariance between these two, we can get it. Okay, so but this is time varying covariance. Again, why we want each day's covariance is we want to allocate each day's portfolio weights. Okay, so each day's portfolio weight will give again to us 4194 portfolio weights. Now we can get the mean of that portfolio weight. The paper I have shared with you, you can see one portfolio weight. I have shared with you last day. Okay, I'll just. Yes, just see. This is the portfolio weights when you get between these two countries, suppose say Brazil and Russia. So you are getting this 0.47 is the mean value of that portfolio weights. When you say mean value of that portfolio weights, all those 4,000 say observations or 4,000 number of portfolio weights you have created, and you are getting the mean value of this portfolio weights. Are you getting? We need to calculate. Now we need to apply one of the portfolio weights, then you can realize how it is happening. Okay. So you can take this V1 and V2. Okay. And suppose between two, we want to check between variable 1 and variable 2, variance and covariance. So this is V3, 4. Okay, we want this V1, 2. Okay. Suppose I will cut this. Okay. This is the covariance, right? Now we can take either one variance, because we will either 1 or 2. You can delete this 2. So I'll say this is variance. Now we want to apply this portfolio weight formula. The portfolio weight formula HT okay. So HTJ, can we copy this? Okay, let us see. We can see from that file and apply. So see, first is I want for ith security, the first security, wait for ith security at time t. So I'll say this is equals to ith variance. So I want for v1. So okay, I want for v2, then v1's the variance. Suppose I want for wait for ith security, I will put the jth variance. Suppose this j you can consider v1 variance or variance of this 1 or 1 first security. Then you can say minus htij. So minus, you can say htij is this, that means covariance between these two. Now divided by hti. Okay, we have missed that. Okay, divided by hti, we have considered this as the okay. Yes, so we need these two only, that's why. So this you can say this is our j, or you can say this is I, this is j, this is ij. Okay, that means this is variance. Is it visible to all of you? Is it visible to all of you?
Yes, sir.
So this is variance of I, then this is also variance of j, then this is covariance. Okay. Now we will calculate the portfolio weights equals to, what is the formula? HTJ. Now you can say equals to HTJ, that is the variance of J, minus HTI IJ, that is the covariance, and you can put it in bracket, these two, then whole divided by, what is there? HTI. So HTI, then minus 2 into HTIJ. So you can say minus 2 multiplied by HTIJ, okay, then plus HTJ. So you can say plus HTJ. Okay. Now you got the portfolio weight for this today, that is the first day. You can just scroll it, you will get the portfolio weight for all the days. Okay. So whatever number of observations you are having, so wherever that up to whatever number of observation that are available, you will get each day's portfolio weights. Okay. Now what you need to do, this is not required for you. Now what you need to do, just do summary statistics of that portfolio weight. So this is the portfolio weight we got. Or simply you can say mean, you can say equals to average
Sir, bracket error maybe होता है.
Yes. This was the error. Yeah, that's why this 8 point means it is too high. Yes, we have missed to give this bracket. Thank you. Yeah. Now you can see, yes, now this is the correct portfolio weight. Now what happens between these two countries, 1 and 2? 1 means that is Brazil and Russia. Okay, between this Brazil and Russia, what happens? You put 61% of your total portfolio in Brazil and 31% in Russia. So this is your mean value of portfolio weight. You got one single value. Who was asking? Sanjana? You got it now? You got the one value of portfolio weight?
Sir, I didn't do the variance covariance, but I understood. So we have to take B1 and B2 from the rats, right?
Yeah, between two variables we have to do. So now we have 5 variables. You can see all the V1 you will get, like for V4 is there, V3 is there, now V2, V3, V4. Then again V5 also you will get. Where is that? So V5 also. So all these, so for all these group of countries or all these group of variables, you need to calculate separately.
Sir, I lost in between. That was coming, the weights were coming out to be 8 point something.
That only we have missed out with that 8 point something was wrong, because we have not given this bracket over here. You just give the bracket so that you will get the exact one. So the idea is, out of $1, suppose you have to invest $1, how much you will invest in Brazil and how much you will invest in Russia. So the first one is the first country that you have selected, that is Brazil. So you will invest 60 out of $1, 60 cents in Brazil and 39 cents in Russia, or 61 cents in Brazil and 39 cents in Russia. So this is a bivariate portfolio weight. You can do it with 2 securities or 2 countries, not more than that. So two countries you can give, like in the paper in the paper that I have shared, 2 papers you can see. So 2 countries pair we have given. Yes. So 2 pair you are getting. So 2 pairs in each of these periods, crisis, post-crisis, or during crisis or full. So 2 pair you need to do. So to get this table, you need to spend at least some time to come out, because for one value you can see you are taking at least 5-10 minutes. Okay. So you can get it through that only. So for whenever this MGARCH model we run, the benefit is we are getting variance covariance matrix that we are using for our portfolio weights. Are you clear? Are you clear?
Yes, sir.
Now you come to another model called CCC model. Either you can go to any of the GARCH model. Either this is Beck model or CCC or DCC. So this is constant correlation, that is CCC, and that constant correlation has been removed in DCC, that is called dynamic conditional correlation model. So you can say constant conditional correlation model. The same way you will get this B1, B2, B3, B4, B5 up to all the pairs. So you can see that you can construct that matrix based on your number of variables. So you can change this coding. So since I have shared with you 5 variables, this is for 5 variables code. If you want for 2, you can reduce it to 2. If you want to for 10, you can also do for 10. Now you can run through. At a time also you can select all and run through. You can select and click on this run. It will run and it will give you. But one by one, if you run, then you can print it. When you print, you will get that variance covariance matrix ka series. Then you can use it. Clear? So now you
Yes,
can
sir.
do that portfolio weights.
So this method of calculating portfolio weights is known as MGARCH. Like all the things you've done.
No. Don't mix up. See, MGARCH model is there to give us volatility spillover. Okay. The portfolio weight can be done only when we get the variance covariance matrix, and that variance covariance matrix is time varying variance covariance matrix. When we say time varying variance covariance matrix, we should use some time varying volatility models that are MGARCH models. Okay, so that is helping us to get the portfolio weights. But MGARCH models objective is not only the portfolio weights. Portfolio weight is extension of that, but our objective is to see the
So
volatility.
MGARCH models are used for like volatility spillover thing, like to
Yes,
assess the spillover of different markets on one market.
yes. So that is MGARCH model. So we are extracting variance covariance matrix out of that. Okay.
Yeah, understood.
Yes. So any doubt on this? Now you can, if we say calculate portfolio weights, if we will give you assignment, you can do it. Calculate portfolio weights of 4 securities or 5 securities. Yes or no? Yes or no? Yes or no? If it is no also, you tell. You will try. If you will face any problem, you can ask. Okay. Another part that I want to show you is, you can see, you can get all these. Only the sorting side you need to take care. Whenever you sort, whether it is DCC result or CCC result, you can print separately one result. Okay. So whenever you say print, it will be print above. So you can remove the remove this, and again you can use one print command to get one results print or one model's variance covariance matrix print. Okay, so other part is we have shown you something on this one, Diebold-Yilmaz spillover. That day we have done how to what is the difference between this M-Garch model and Diebold-Yilmaz spillover. I'll show you. You can run through. All of you are having this file, Diebold-Yilmaz. Last class I have sent to you. How many of you are having this file? How many of you are having this Diebold-Yilmaz file? अरे भाई yes or no बोलो, हाँ और ना बोलो. Okay, I have sent to you. You can without having any data also. You have one data that is sent to you as DUI IJF 2012 dataset. You can import that, and whatever you will get is the Diebold-Yilmaz spillover result. We'll see how it works. So DUI spillover data you can access, and you can compute and give different names for different markets. Then what happens, we'll come out with I told you how to get this volatility plot. We'll come out with one matrix, volatility spillover matrix, that will help us to say whether one market is volatility transmitter or volatility receiver. Yes, so this result you can copy. It is there in the paper also, in the Diebold-Yilmaz paper that I have shared with you. So I'll tell you what is the difference between this Diebold-Yilmaz spillover index and this one. M-Garch model. I'll tell you. Just give me 1 second. For sorting, you need to be carefully sort the data so that okay. So this is from others. Okay. Now what happens? Whatever we are getting over here is, it is just like, it looks like a correlation matrix. Okay. It is like stock to stock, how much spillover is there, bond to bond how much is there, bond to stock how much is there. So it is giving us spillover between two markets and overall spillover also. This 12.60 is called as, this is called as total spillover. So total volatility spillover. So now what happens here, we can get one thing called net spillover. Net spillover means it is, you can say, contribution to others. I told you the other day how much it is spillovering to other countries, and contribution from others, how much it is receiving from others. So I'll say net is equals to two others per stock. If I say net equals to two others minus from others. Okay, this is net. Now for bond, I'll say two others minus from others. This is net. Commodity, two others minus from others. This is net. For forex, two others minus from others. This is net. Okay. This is called as net spillover. But how does this net spillover helps us? it helps us whether one country is volatility transmitter or it is a receiver. If this net spillover is positive, that means it is spillovering more to others. That means this particular asset class is a net volatility transmitter or receiver. This is transmitter. Okay, and other are like negative. These are all net volatility receivers. Okay, these are all net volatility receivers. So this is not possible in case of MGARS model. MGARS model will have n number of coefficients. That's how we have seen 1 to 1, 1 to 1. We have to give. Then this is the recent development in the volatility spillover theory or volatility spillover model. So it will give us whether one country is net volatility transmitter or it is net volatility receiver. So with this volatility is closed. Like we will stop over here with volatility. Next class we'll do the bond valuation. Maybe in one class we'll complete. We'll wind up since only few of you are there. You are attending at all. So we'll meet maybe next Saturday or Friday, and we'll close all the session. So thank you all.
Sir, I just had one question.
Yeah. Please.
Sir, this rats part is coming in the examination or not?
Now we'll give you some assignment on rats. So you can. Yeah, you
So
can
final
do it.
exams may we should not expect
Will not
that, right?
give rats, but for others in
All
the
right.
last class we'll discuss what are the things you can read
All
through.
right, sir. So it will be perfect if you can give like a comprehensive syllabus so that we can prepare for the finals.
Or whole of the syllabus will come. You have studied the whole of the syllabus now before.
हाँ सर जो आपने
Yeah.
जो सिलेबस खोला था उसमें जो हाईलाइट किया था सर
हाईलाइट जो किए थे कि हम कवर करने के लिए क्लास
कवर करने वाले हैं करेक्ट सो अगर मॉड्यूल भी आप बता देंगे कि पूरा मॉड्यूल्स आने वाला है तो विल प्रिपेयर अकॉर्डिंगली
So next class that will be last class we'll declare. So we'll
all
cover.
right.
Okay, thank you.
Perfect. Okay.
Sir,
Yeah, hi, Harshita.
Sir, can you please also share the recordings of the previous classes?
I have shared 2 classes, I think. All recordings if I am sharing na, others are not joining. Just see, recording तो मिल रहा है, क्यों जाके उधर क्वेश्चन आंसर करना है? इधर तो recording सुनोगे, दूसरा साइड से कुछ पूछते नहीं.
सर फिर हमें तो रिवीजन करने का मौका मिल जाएगा ना जिन्होंने अटेंड करी है.
हाँ, अटेंड कर रही है, लेकिन जिन्होंने अटेंड नहीं किए हैं
सर उनको छोड़ दो ना, आप हमारा सोचो ना, हमें चाहिए रिकॉर्डिंग्स.
हम तो कर रहे हैं.
हाँ
तो ठीक है, वो दे देंगे. आप ये वाला असाइनमेंट नेक्स्ट क्लास के पहले सबमिट कर दो. असाइनमेंट है कि पोर्टफोलियो वेट निकालना है. ठीक है, आप किसी भी 4 स्टॉक्स ले लो या 5 स्टॉक्स ले लो या 5 कंट्रीज का स्टॉक ले लो, लेकिन पोर्टफोलियो वेट निकाल के दो. ओके, थैंक यू ऑल.
Thank you, sir.
Thank you, sir.